Welcome to the Deep Dive. Today we are strapping in for a really critical market check. We're taking a precise snapshot as of December 3rd, 2025. You've sent us a ton of source material detailing all the recent rate movements, the liquidity shifts, and, well, the chaos that follows in high-risk assets. So our mission is pretty simple. Distill the three big forces shaping your portfolio right now.
That's right. And we have to go beyond the headlines here. The key drivers are, the Fed's shifting expectations around rate cuts, the dramatic and I think largely overlooked disappearance of excess market liquidity.
Yeah.
And how those two things are smashing together to cause just, profound turbulence, especially in crypto.
Right.
The market isn't just reacting to data anymore. It's oscillating just wildly between anticipating a massive policy shift and at the same time desperately needing proof that those cuts are actually coming.
Okay, let's unpack this. We should probably start with the macro foundation, the engine room of the economy. So we're looking at the yield curve, and this is where the conflict starts. Current U.S. Treasury yields. You've got the 10-year sitting around 4.09%, while the shorter 2-year yield is at 3.53%.
And the 56 basis point spread, that's hugely significant. It means the curve is positively sloped. It is absolutely not inverted. And if you connect that to the bigger picture, a positive slope like that usually tells you that long-term risk and growth expectations are holding up. But 56 basis points, that's not exactly screaming runaway optimism.
No.
It suggests the market has very, very strongly priced in this assumption of aggressive Fed easing starting soon, maybe even mid-December.
That brings up a question for me right away. Does a 56 basis point spread mean the market has taken recession risk off the table? Or is it just reflecting this aggressive pricing for cuts that, might not even happen?
It's the latter. Absolutely the latter. This non-inversion is conditional. It is based entirely on the conviction that the Fed will ease. The second that expectation gets challenged, let's say the mid-December CPI number comes in hot.
Oh, that curve could flatten fast.
Yeah. It could flatten in a heartbeat or even invert again. The market is basically functioning on hope right now.
So hope is driving the rates. But the deeper thing, the structural change we need to talk about, is liquidity. This is where we hit the real aha moment in the sources, the disappearance of that free money cushion. M2 money supply is showing marginal growth, nothing dramatic, but the critical detail. It's the Fed's overnight reverse repurchase agreement, the RRP balance.
This is the real story. I think it's getting buried under all the day-to-day stock movements. The RRP is essentially where money market funds and other institutions park their extra cash overnight with the Fed. It's a key measure of excess liquidity.
And what we saw was a collapse.
A collapse is the correct word. As of December 1st, that RRP balance just plunged. It's down to only about $3.24 billion. And just for context, for you listening, back in 2022, this balance peaked well into the trillions.
Wait. 3.24 billion. That's not a rounding error. That's basically zero compared to the peak. How does the financial system even absorb the removal of what was like a $1 trillion safety net?
That is the pivotal question. When the RRP balance drops this low, it means that short-term excess liquidity has just vanished. That huge reserve of free money, that cash cushion, it's been pulled back into the system. And when that cushion disappears, the system becomes far less tolerant of risk. Banks need to hoard cash, margin requirements get tighter, and the highly speculative assets, they get starved of funding.
So we have a market running on the hope of rate cuts, which stabilizes the curve, but at the same time, it's losing its liquidity safety net, which should be causing panic. And yet, the VIX, the fear index, is sitting pretty low, around 16.6.
Central, yeah.
The dollar index, the DXY, is neutral but strong, around 99.2.
How do we reconcile this? Calm sentiment with the liquidity squeeze. That's the classic mixed picture. Look, institutional money, which dominates the S&P and the VIX, is focused on the future. They're focused on the potential Fed cuts, which promise easier conditions down the road. They're positioned for growth.
Gotcha.
But the highly leveraged sectors, the speculative ones, they are feeling the pain right now. The RRP drop means the plumbing of the short-term financing market is under stress. The squeeze is hitting those marginal players first.
And that tension-calm institutional money focused on future cuts colliding with the immediate pain of vanishing liquidity, that brings us perfectly to our next segment, the huge asset class divergence we're seeing. It's a tale of tech strengths versus crypto volatility.
Absolutely. Just look at equities. Risk preference is mixed, but that rate cut expectation is fueling growth assets. The S&P 500 ETF VOO is steady, around $626 to $627. But the real story is the Nasdaq Q100 ETF QQQM. It's outperforming. It's priced around $256.
And QQQM's outperformance is anchored by one thing, isn't it? AI. The structural play that funds are clinging to is the long-term secular growth of artificial intelligence.
Precisely. If you dig into the specific stocks in the sources, they show this feverish, concentrated focus. NVDA is holding strong, 178 to 180. Meta is exceptionally strong, trading between 640 and 660, driven by ad recovery and their huge AI investment.
And Alphabet is in there too.
Alphabet, yeah, around 310, 320. These companies are seen as generating actual earnings from this growth. It's not just hype anymore.
But when we see that kind of concentration in just a handful of names, are we running the risk of just chasing performance? I mean, isn't this becoming a super concentrated trade? And how do you protect yourself if one of those core drivers were to falter?
That's a crucial point. And you're right, concentration risk is high. The market is differentiating between quality and pure speculation. Funds are flooding into these names because they're the few places where structural growth meets confirmed profitability. Protection, and we'll get to this, comes from using broad vehicles like VOO for your core and then allocating tactical capital to those proven AI leaders. The market is just willing to pay a huge premium for certainty of growth right now.
And that stability in big tech stands in such stark contrast to the crypto market. That's where the liquidity squeeze and the leverage headache just become painfully obvious.
Dramatic volatility doesn't even begin to cover it. Bitcoin, trading around 90 to 92K, it experienced a massive wave of forced selling that triggered these huge, large-scale leverage clearouts. This is the direct result of that vanishing RRP cushion we were talking about.
Can you break that down for our listener? What does a leverage clearout actually mean here?
Yeah, so think of it like pulling a rug out from under a bunch of highly indebted speculators. A lot of crypto traders use 5x, 10x, even 20x leverage. When the price dips suddenly, their positions quickly become insolvent, and in a tight liquidity environment, they can't post more collateral to cover their losses.
So they get liquidated.
They get automatically liquidated, and that forced selling drives the price down way faster than fundamentals would suggest. It creates a nasty feedback loop.
And we saw ETH follow suit, trading around 2,900 to 3,000, with metrics showing it's still under pressure. The sentiment backs this up too. The Crypto Fear and Greed Index is stuck firmly in that fear to neutral zone, about 30 to 40.
And you can see this relative weakness in the Bitcoin to gold ratio. When you compare Bitcoin's performance to a traditional hard asset, BTC is worth about 21 to 22 ounces of gold. Gold has had a remarkably strong 2025.
Right.
So it tells you that right now, investors are prioritizing the hard asset hedge over digital speculation, especially as liquidity vanishes.
It's interesting, though, the speculation hasn't completely disappeared. It's just concentrated in these super high-risk areas. Our sources noted this focus on what we call pre-stocks. We should probably clarify that term.
Yeah, this is a bit of jargon, so let's define it.
Yeah.
Pre-stocks are highly speculative, usually decentralized tokens, often built on something like Solana.
Yeah.
And they're designed to try and track the valuation of private companies, like Anthropic or XAI, before they go public.
So they're basically high beta proxies for future growth.
Exactly. Pure speculation on future IPOs. But the source notes are clear. These are extremely sensitive to the very pressures we've been discussing. Liquidity constraints and the threat of regulation are the two big risks there. That sector is maybe the most sensitive to the disappearing RRP.
Okay, let's unpack this and move into the playbook. We had this sharp divergence. Stable AI leaders versus volatile crypto, all underpinned by this disappearing liquidity cushion, but hopeful rate cuts. What's the recommended strategy for the learner right now?
The overall context demands a segmented position with strict risk control. You need a layered defense. So the defensive priority has to be maintaining core, low volatility holdings in broad ETFs like VOO and QQQM. They give you stability and capture that structural AI trend without taking on single stock risk.
And on the more tactical, aggressive side of the portfolio, where you want to chase that outperformance.
Tactical exposure has to be strictly focused on those high-quality AI and semiconductor companies we mentioned. NVDA, Alphabet, Meta. They are driving actual earnings that support the valuations. If you go chasing smaller tech stocks, you're just introducing massive liquidity risk into your portfolio.
And let's talk specifically about digital assets. Given the liquidation pressure we just discussed, that huge leverage clearout, what's the mandate for crypto?
Extreme caution. The mandate is that leverage must be strictly controlled. Ideally, that means zero leverage. Trading should prioritize spot assets, meaning you own the actual BTC or ETH, and use strict, non-negotiable stop-loss orders. This is just not the environment for high multiplier derivatives. The risk right now is the plumbing of that market failing, not necessarily just regulation.
That makes perfect sense. The volatility is self-inflicted by the leverage already in the system. So as we look ahead, what's the one anchor point, the data that's going to drive the next phase?
All eyes have to be on the mid-December data releases, specifically the official CPI release for inflation, and then the commentary from Fed officials that follows. Those two data points will decide what happens with the yield curve and determine the market's real risk appetite heading into the new year. That is the line in the sand.
Which brings us to our final thought. The key takeaway sentence really seems to be this. The market is in a structural transition. Short-term volatility is high, especially in crypto, but the confirmation of a Fed rate cut path would finally unlock those structural opportunities in core growth assets like AI.
It's a fragile equilibrium. It's maintained entirely by future expectations, not by current liquidity.
And that leads to a final provocative thought for you to mull over. We've established that the massive excess liquidity, that financial safety net symbolized by the RRP, has basically disappeared. So if the market no longer has that liquidity cushion, does its dependence on the Fed now shift almost entirely from managing the money supply to purely managing forward-looking expectations? I mean, what does a truly liquidity-starved market look like when the Fed's only real tool left is just communication? That's the structural shift we need to watch unfold next.